What's up, everyone? Thank you so much for joining us today on this very special live stream. Today, I'm going to be confronting Nick from Reventure Consulting. What's up, everyone? Thank you so much for joining us today on this very special live stream. Today, I'm going to be confronting Nick from Reventure Consulting. Oh, I was hearing my own audio there for a second. So Nick is a big bear on the housing market, and he thinks that everything is going to come to a screeching halt this year in 2022, and it's not looking good. The outlook is grim. And for anybody who sticks around later on in the video, we're going to be talking specifically about Florida's housing market, so make sure you watch all the way to the end. So Nick, tell me why you think exactly the housing market crash is going to come in 2022, and where do you think we're going to get hit the hardest?
Sure. Well, first thing, Michael, it's great to be back with you. This is the second time we're doing this, so I'm super excited. And, more broadly, the thing to know about the housing market in 2022 is that it's arguably the biggest bubble of all time, not just based off, someone saying something, but based off actual data. When you look at home prices adjusted for inflation from the Case-Shiller Home Price Index, we're at the highest level ever right now in 2022, above the levels in 2006, which was previously the biggest housing bubble of all time. And when you look at all these fundamental data points, which is something I do consistently on my channel, Reventure Consulting, you're only left with one conclusion, and that's that we are in a massive housing bubble right now. The underlying fundamentals do not support what's going on in the housing market. This is very speculation driven. That's the thing people need to understand. This is a speculation driven market, not a fundamental one. And now that the Federal Reserve is going into tightening mode and is increasing interest rates and is going to be contracting the money supply, this is when the speculation starts to come to an end. And that's going to happen in 2022. But as we're going to talk about in this video, it's going to happen in certain parts of the country first. This is not going to be like an even distribution of a housing crash. We're going to see it in certain parts of the country first, while other parts of the country are still booming. But then slowly but surely, it's going to make its way and touch every part of America.
So do you think that it's possible that there are any places in the United States right now that are going to be safe from a housing market crash? Or do you think we're all going to feel it in some form or another?
Yeah, that's a great question. I think, look, there are certainly certain places that are safer. I think, though, it's reasonable to expect that everywhere in America is going to go down by some degree. The question is that going to be a 5% decline, or is that going to be a 35% decline? And of course, you'd rather be in the market or buying into the market right now that's going to have a 5% decline. So expecting a broader decline everywhere is realistic given the direction of interest rates and monetary policy. However, it's really the markets, and I've kind of developed a system with my company, my YouTube channel, to identify markets that are most at risk. It's really three key criteria for a market that's at risk of a big decline in home values in the upcoming housing crash. Number one is, are home prices and mortgage payments in your city detached from wages and income? So if home prices and mortgage payments have gone way up above what the levels of wages and income support, that historically is a telltale sign that your market's in a housing bubble. Number two is if there's a lot of new home building occurring. A lot of people talk about the housing shortage in America. We're not building enough homes. You could say that about certain parts of the country maybe, but you certainly couldn't say that about Texas or even Florida. In most parts of these states, we're building a lot of new homes. That increases the risk of a housing crash. But then number three is also, you got to think about the economics of the region. Does the region have strong economic drivers and most fundamentally diverse economic drivers? If it does, it's less likely to experience a crash. Conversely, if an area is like very focused in its economy on one industry only, that makes it more exposed to a downturn, especially in a rising interest rate environment that could be problematic for certain sectors of the economy.
I see. So are you saying that all of these areas that are going to be seeing a crash, you look at the data based on what's happening, all these points you just mentioned, and that pretty much can almost guarantee that there's going to be a housing market crash?
Sure. Well, I guess, look, guarantee is a tough word to use. I think of it in terms of like probabilities. Where is the probability more likely that there's going to be a housing crash? And look, there's certain markets like Austin, Texas, and Boise, Idaho that, my personal probability of there being a crash in those markets is, close to 100%. There's other markets like maybe a Miami where I am not as confident, right? There's certain aspects of a Miami that scream kind of like a bubble. But as we talked about in our previous video, there's other aspects to Miami that make it look not like a bubble. And it's kind of trying to discern what the probability of that occurring in your market is. That's kind of the best way to think of it from a probability driven perspective. And, when you really get also more into the weeds, you'll realize that certain neighborhoods and zip codes within certain cities are more exposed to housing downturns. Like if you go back to 2008, if you went to Dallas, Texas in 2008, there were neighborhoods that went down by 50% in that housing crash, and there were neighborhoods that didn't go down, right? And so from a macro and a micro level, it's trying to understand the risk factors as far as that goes.
Absolutely. Well, we'll definitely be pulling up some data later on in this video to share with everyone. That way you can show us where you think the market's going to get hit the hardest. And in the meantime, before we do that, what do you think is going to happen with the interest rates? In a lot of cases, we're seeing that in some areas, you could already be paying close to a 6% interest rate for a 30-year fixed mortgage. And just a couple of months ago, that number was in 3.5% range. Yeah. Now we're already close to 6%. Do you think this is going to have an impact or maybe a part of what's going to be the cause of the housing market crash?
For sure. I mean, look, you can think of the mortgage rate, it's the cost of home ownership. And when you combine surging home values with surging mortgage rates, that's a nasty combination because really you got to think about it. The US housing market is a mortgage market. There's a lot of, there are a lot of people buying in cash right now, but still over 70% of purchases are done with a mortgage. So if you increase the cost of a mortgage substantially through appreciation and higher mortgage rates, it's a double whammy on the home buyer. And, unfortunately, the wages haven't grown enough to support these increases in home prices and mortgage rates. So when the mortgage rate goes from, the way to think about this kind of is when the mortgage rate goes from 3 to 5, that's essentially, you just increased the cost of buying a home by 20% just because the mortgage rate went up from 3 to 5. And, I think during the pandemic, certainly certain sectors of society and the workforce are doing better, but most people's wages haven't really gone up by much more than 5 or 6 or 7% in the last year. So when you have that surging mortgage rate, the way people need to think about it is it's constraining affordability. And if you make the assumption that, banks making loans are making good loans and that we're not going to see a return to the mid 2000s of banks just giving a loan to whoever, the logical conclusion is that, people aren't going to qualify for homes anymore due to the higher mortgage rates. And that's going to decrease home sales, which we're already seeing occur, which will increase inventory. So I think the higher mortgage rates are going to have a big impact, but it's going to be felt in certain parts of the country first. The areas that are most exposed to surging mortgage rates are ones where the prices are already high relative to what people make. So if you go to like a Seattle, right, in the Seattle metro, people were already having to stretch on their ability to purchase a home and afford a home, qualify for the loan. When you then suddenly jack the mortgage rate up in a Seattle, that's kind of devastating to the fundamental demand of that housing market because people already couldn't afford it. Now you increase the mortgage rate and a lot of people can't afford it now. So we're going to see higher cost metros bear the brunt of this increase in mortgage rates first.
So what do you think is going to happen to these people that are dashing out there right now to buy before the supposed crash is coming? They're getting a higher interest rate than they would have got a few months ago. Obviously, they're well qualified because they wouldn't be able to get that loan, but they're probably getting a loan somewhere in the 5 to 6% range, paying all-time high prices for that property, regardless of where that's at. What do you think is going to happen to those people?
I would just, look, one thing I'm very careful of, trying to understand is that people have different reasons for wanting to buy a house. And for some people, it's not always like the dollars and cents and the valuation. Some people just need a home. And so I think there are certain people buying right now who, have a kid on the way or, they really need the space that a home provides. And to them, overpaying on price or paying a higher mortgage cost is secondary. So, I would say those people, it's not a big deal. But more broadly, look, if you're buying right now, you better make sure you like the place you're buying. That's the one thing I'm telling people because, you're buying an all-time high price and an all-time high mortgage payment. Hopefully you like the place you buy, because you do not want to be in a situation where you have buyer's remorse and then in 2 years you feel compelled to sell your home because you don't like it or it didn't fit what you needed and you need something more or something bigger. I think people who are in that position could get really hurt by buying right now if they're buying a place that they're only going to be in for a couple of years or that they don't really like. It's a FOMO purchase. I think people in that scenario could be in deep trouble. Conversely, those buying because they really like their home and they plan to stay in it for over a decade, I'm not as concerned for them.
Yeah, I would definitely agree with you there, Nick. I think that anybody looking right now, if you are going to make any sort of compromise at all, you better second guess that purchase, because like Nick just said, you could be stuck in that property for a while. And if you are in a position where you need to sell it in the next couple of years, you could be looking at big trouble. I totally agree with that.
You know, it's interesting. I saw a report from Redfin a couple of weeks ago, and they were giving, I'm not sure if they were giving advice, but they basically were talking about like how to win an offer in this market, how to win a bid. And they were talking about like, and I don't want to say they were encouraging people to waive the inspection and the appraisal, but Redfin was like talking about that. And I thought that was so crazy that Redfin was like discussing that you should waive an inspection and an appraisal to win a bid. And I was like, that just by itself, forget all the data. Like that's a sign of how messed up this market is, that like a big online realtor shop like Redfin is talking about waiving inspections and appraisals. Like regardless of what you could say about the market or the housing shortage, that's not a good thing to do, right? That's not a smart thing to do. And so I thought that was very telling to see that that's kind of becoming accepted in this market from a behavioral standpoint. That is a sign of a bubble.
Absolutely. And even things like that could probably cause a lot of buyer's remorse in the future, because if you think about it, if you figure out one day, oh my God, this house needs 50 grand worth of work that I didn't know about because I never inspected it, or it turns out it's actually worth 200K less than I paid for it, or I had no clue.
Yeah.
Guess what?
Yeah. Yeah. You're putting yourself at big risk.
Yeah, absolutely. So why don't you tell us why you think that, well, let's get into the migration first of all. Let's get into where people are moving in the United States, and how do you think this is going to fare better for some? Like we mentioned earlier, you think that the crash is definitely going to start in some areas and hit some areas harder than others. So why don't we pull up that map that you were showing me?
Sure. Yeah. And right before I do that, I'm going to show you guys a map on inventory all around America. It's going to be very telling to see where the crash is going to start. But just to zoom out, we have the pandemic migration, right, that occurred in 2020 and 2021. This was a big thing that kind of laid the foundation for what we're seeing in today's housing market. Lots of people left California and New York and went to new cities. Now, when you look at the migration data, it's interesting. The migration data validates the housing boom we've seen in a place like Boise, Idaho, or a place like Naples, Florida. There was legitimately, according to the census, a massive increase in the amount of people moving to those areas during the pandemic. Now, at the other end of the spectrum, there's places like Atlanta, Georgia, and Las Vegas, Nevada, which actually had fewer people move there during the pandemic than previous years. So this is really interesting, is that there was legitimate surges in migration to certain parts of America during the pandemic, but then there was other areas where you would have thought like in Atlanta or Vegas would have received a lot of people, but they didn't. And so this was something that was really interesting to me when I dug into the census migration data. I've done that on my channel a couple times, but where this is really relevant for you today as a home buyer is that some of these migration trends are now ending. We are seeing fewer people leave California and go to the new city. We are seeing fewer people leave New York and go to the new city. And that is causing certain big differences in inventory to show up on the US housing market. So I'm going to share my screen here and show you all what I'm talking about. Because basically, when you look at inventory, this is going to give you the key insight into where the crash is going to start first. And on this map, we're looking at the change in inventory, aka the homes for sale on the US housing market in the largest counties in America. So each one of these geographic identifiers is a county. And what I want you to pay attention to is the color coding here. The bluer the county looks, the more that inventory is increased year over year. So you can see in a place like Ada County in Boise, Idaho, inventory is up 62% year over year. That's what this data means. And what do you see, folks, is that we have a lot of blue on the West Coast in America, up through Pinal County, which is near Phoenix, Arizona. We have a 46% increase in inventory. Heading towards Reno, we're having big increases in inventory. Nevada, touched upon Idaho, Northern California, we're seeing this. So we have a lot of inventory increases. And to me, this is a sign that the migration that we saw out of San Francisco and LA to these places is slowing. We're going into reverse. So we're seeing inventory go up in these places that were in a big boom in 2020 and 2021, but no more. These areas in blue are going to be the first places to go down in the crash. Now, it's not just the West Coast, though. We have certain parts of Texas around Austin where inventory is going up a lot, as well as Waco, as well as southern Dallas. And then interestingly, if we go into parts of rural Georgia near Atlanta, inventory, look, in Morgan County is double where it was a year ago, into Tennessee and also Indiana. So we're seeing these pockets already, folks. Like in front of your eyes, we're seeing more homes come to market. And these are the places that are going to have the housing crash first. Conversely, the areas in red are still seeing a decline in inventory year over year. Florida's a big one. As I'm sure you know, Michael, inventory is still going down in Miami-Dade County, as it is in the Southeast, on the Southeast coast, as it is in parts of the Northeast and Connecticut. So there's big differences that exist in America of where inventory is going. And this is a clue to you as a home buyer or real estate investor where the crash is going to start first. And so, I don't know if you have any questions on this, Michael. Does this make sense to you?
Yeah, absolutely. I think that, it makes a lot of sense. People that look at this map right now, if you live or thinking of buying in one of these areas that are in blue, you could be in trouble. You're going to be the first one that's going to be seeing trouble. But
That's
I
right.
think it also doesn't mean that just because if you buy in an area that's in red on this map, for example, doesn't mean you won't get hit with a housing crash. It just might not be as severe as it might be in one of these blue areas.
Correct. Or it could also be a timing thing, right? So let's take a look at Florida in more detail, right? We're looking at every county here in the state of Florida. Again, looking at how inventory has changed year over year. And so, Miami-Dade, inventory is down 52% from where it was a year ago. This is one of the hottest markets in America. Inventory is still going down. It's still a crazy market in Miami-Dade and Broward and Palm Beach. And basically the fact that all Florida is red, up to Osceola County and Orange County and Orlando, 40% inventory decline. So it's just what this says. It's like hell to be a buyer right now in any of these places in red. There's nothing on the market. It's a peak seller's market. And, the other side of the coin is, the crash is going to take longer to play out. Like it's not going to happen overnight in a place like Orlando or Miami, if it even does. So it's gonna take more time to play out. Conversely, if we were to go to like the Panhandle, we see maybe in Pensacola, we have slight upticks in inventory. We see some blue or some translucent colors here in northern Florida. Maybe if we go to like Clay County and Jacksonville, we're starting to see some softening. So, if you're someone just desperate to buy today and you want a place where there's more inventory, where you have more to choose from, these places in blue could offer that. Maybe Hernando County in northern Tampa is seeing an increase in inventory. But like you said, Michael, like it's tough because you would say these markets are closer to the crash. So you could be buying at the peak price just before it goes down in a place where inventory is starting to go up.
Yeah, absolutely. And I heard recently that in some of these areas where the inventory is going up, that sellers are even starting to slash their prices. I don't know by how much, but it'd be interesting to see if you can actually get a deal already in one of these areas in blue, if there's actually a deal to be made where you don't have to pay full price and you're not going to be in a bidding war for buying one of these properties.
It's a good question. I'm hearing reports of that as well. But I think more broadly in Florida, it's going to be tough to get a deal right now. I think it's going to take a couple more months. But if we move to Georgia, I'm going to just show you the difference. You see the difference immediately in the map, right?
Absolutely.
We have lots of blue around Atlanta, lots of blue, Paulding County in Atlanta, Douglas County, Rockdale County, Newton County, lots of increases in inventory in these kind of suburban to fringe rural counties around Atlanta and rural Georgia up to northern Georgia heading towards Tennessee. You could see night and day this map compared to Florida. So I bet you could start to get some deals in some of these counties. If you see inventory up 50 to 100% year over year in your county, you could potentially get a price cut, maybe not as much buyer competition in a place like that. I think another interesting place to look at would be Texas, because we have a lot of home buyers who are looking in Texas. And, this is one where it's more in between. There's places that are still really hot. Like I live in Dallas County, and inventory is down 40% year over year in Dallas County, hard to buy. But if you go to Ellis County to the south, or Navarro County, or down to Waco, we have more inventory on the market. And, one trend I've actually observed is that rural counties, more suburban and rural areas that kind of boomed during the pandemic, we're starting to see softening in those places. So not only maybe did the pandemic exodus from California and New York slow, I think the broader exodus we saw from a Dallas to the suburb is also starting to slow. So don't be surprised if more rural locations, you see in Austin, Bastrop County up 65%. Don't be surprised if in more rural locations we see more deals, more softening, more price cuts in 2022.
Yeah, absolutely. The thing I would say about that is, like, first of all, I think a lot of people are getting more comfortable with moving back to the city. Not only do people that used to live in the city, maybe they're missing the city lifestyle after not having it for a while. The suburbs have gotten kind of stale for them. And also, now that things are going back to normal, there's maybe even a little bit of a demand for some people that want to actually go back to the office or just be around more people, live in a more urban area. They're not worried about the pandemic anymore. So I can totally see that being a trend. And I would also say to people that if you are looking to buy in one of these blue areas, and for example, you see the inventory going up and up and up, but the prices keep going up with it, you need to be very careful. Because if you see a lot of that inventory going up and the prices are going up with it, people are just basically asking whatever they want at this point. And that's a warning sign for you as a buyer. Wait a minute, maybe I can actually get a deal on one of these properties instead of being in this mindset where I need to pay over asking price. I need to do a bidding war to get something or waive one of these inspections or appraisals. That's not going to be a good idea if you see the inventory going up in your market.
100%. That's a great point. It's not just the inventory going up; it's the other things that you're also seeing in the market, like prices and price cuts and inspections. And I think more broadly, look, higher mortgage rates historically takes a little time to filter into the housing market. And actually, at first, when mortgage rates go up, historically, there's a phenomenon where when initially the mortgage rates go up, there's actually an increase in demand because people want to lock in their mortgage rate before it goes up further. And I think we're starting to exit that period. We certainly were in the middle of that period in January and February, I think, and maybe part of March, where we had this big wave of people trying to lock in their rate. But the lesson here is you got to give the higher mortgage rates a little time to filter into the housing market in terms of decreased home sales and then higher inventory. And we definitely saw that in March. In certain parts of America, and I'm almost positive when we get the reports for April, we're going to see that even more.
Yeah, I think so too. It's definitely a delayed effect, and probably by the summer is when we're really going to start seeing things slowing down if these rates keep going up.
So another good thing to think about is 2018. Now, that seems like so long ago, 2018. Why does that matter? That's because that was the last time that we saw a big increase in mortgage rates in America. I think the 30-year fix went from 3.7 to 4.9 or 5%. And if you kind of analyze back in 2018, 2019, what happened to the housing market, it's somewhat instructive. And it took about 6 months for those higher mortgage rates to filter into higher inventory. And then it was, like I said earlier, back in 2018, 2019, it was those expensive markets that did the worst due to the higher mortgage rates. We had Seattle, San Francisco, San Jose went into negative territory back in 2019. We also had a lot of vacation markets got hit very hard. This is an important thing for people to pay attention to. Or like second home markets like the Hamptons in New York or like Fisher Island in Miami. A lot of these places did not do well in 2019 when mortgage rates went up, which might be kind of curious at first because you're saying a lot of these people are buying in cash, but more generally, higher interest in mortgage rates tend to hit the higher end of the market more. It also tends to hit if someone is making a purchase that isn't essential for them, like they're buying a second home somewhere, especially if they're using a mortgage to do it, the higher mortgage rates are going to cause a reduction in that. So, I think we're seeing the rural area inventory increase due to the migration trends. We're seeing the inventory increase in higher priced markets due to the mortgage rates. And I wouldn't be surprised if you see those like second home markets, those like specialized second home areas also begin to decline.
Yeah, and obviously anybody looking to buy a second home, they have some extra money on hand, and this probably isn't their first rodeo, and they see interest rates going up, and that's also a red flag for them. Like, well, wait a minute, maybe I should hang on to my money a little bit and see what happens first before just jumping into buying a second home.
100%.
Yeah. So let's get into something here about the housing market crash again, circling back to this. And just for anybody watching right now, real quick, in a little while, once we're done going through some of our information here, we'll take some of your questions later in the end. So make sure you stick around for that. So you're a big proponent of the housing market crash coming this year in 2022, right? So
Yes.
why do you think it's going to be this year in 2022 and not next year or 2024, or maybe it won't come at all? What makes you think that?
Yeah, that's a great question. And look, predicting timing can be a fool's errand sometimes. I think this bubble has already gone on longer than I thought it would, as bubbles tend to do. But I think when you look at the movements in especially monetary policy, look, the one thing to remember about the housing market we've seen to this point is that over the last 2 years, every single thing that occurred from a fiscal and monetary standpoint supported the housing market, whether it was record low interest in mortgage rates, the Federal Reserve buying up mortgage-backed securities, the government sending out stimulus checks to people, the government creating an eviction and foreclosure moratorium. Everything that happened during the pandemic pushed home values up. And now we're entering a phase started in late 2021, but really now in early 2022, where all of that's going into reverse. And so this is like the new dynamic in 2022 that was not around in 2020 and 2021. Rather than supporting the market, all these policies are now going to go against the market and combat the market. And so that's why I believe it's going to start in 2022. But I wouldn't be surprised if, look, I would not be surprised if Florida lasts into 2023. Given how low the inventory is right now. And that's, again, really the thing you should pay attention to. If the inventory is still down 40% year over year, you're not going to probably have a 2022 housing crash.
Right.
But if inventory is up 30% year over year already, you're much more likely to have a 2022 housing crash.
Absolutely. So definitely we're looking at those areas in blue coming in 2022 and possibly later than that if your city is in red, basically.
Correct.
Okay. And what do you think about the job market? How do you think that's going to affect this? Because I just released a video earlier today talking about areas that are basically already recovered from the pandemic and even doing better than they were prior to the pandemic. And it's a pretty short list. We're pretty much talking places like Florida, Texas, Idaho, Utah, and Montana. That report says that these areas have already recovered from the pandemic 100%. All the jobs that they lost are now back. And some of those places even have more jobs than they had before the pandemic started. Do you think that in a situation like that, for example, people move to those areas, there's jobs, the economy's booming. Do you think they're still at threat of seeing a housing market crash? Because some of those cities are in blue and some are in red.
That's a great question. And clearly the broader economic fundamentals are a key piece of how exposed a housing market is or how supported it is. I'll say this. I think there's obviously differences among some of the states and cities you mentioned. But historically, I love going back into history, looking at other housing bubbles and housing crashes, whether they occurred in the mid-2000s or early 90s or mid to late 80s. I've studied a lot of them. And very often, the housing markets that crash are the ones that actually have huge job growth during the bubble. Oftentimes, this is kind of associated. They're kind of associated together. There's like this big sudden surge of people that move in. There's all these jobs that are created at once. But if it's done in a way that's destabilizing and isn't supported necessarily by the fundamentals of how much money people make in the economy, that whole thing can just come crashing down at once. And if you were to go back to the mid-2000s and say, what were the biggest job growth states in the mid-2000s before the housing crash? It was Florida, Arizona, California, right? And those were the ones that crashed the hardest. So I think the way to look at it is, obviously job growth is good. It's objectively good for a housing market. But what I don't think necessarily is good is like this rocket ship type of job growth or migration, where all of a sudden there's like this frenzy of people moving in. Historically, that is a sign there's something frothy going on that might not be so sustainable. It's a sign that a lot of the locals could be displaced. And you brought up Idaho. So that's a great example. Boise has been the #1 job growth market in America the last 5 years. But if actually you look in the last 6 months, its job growth has slowed significantly. And there's now these reports that people are having to leave Boise because they can't afford it anymore. The rent has gone up too much. And so, I think the job growth is good, but what I'm really paying attention to is how much of the rents and home price has gone up relative to how much money people make.
Yeah,
Because
absolutely.
that's going to determine whether the growth is sustainable. If the prices and the rents have gone up by 50% in 2 years and the wages are up by 10%, that job growth isn't going to last, because people are going to cut back their consumer spending because they need to pay for their rent. That's going to reduce money in the economy, or people are going to leave and go someplace else. And so, I'm getting a little long-winded with this response, but one thing that I think is really interesting was the inflation data that was just reported this week. We were at 8.5% inflation nationally, but there's big differences among metro areas in terms of inflation. Phoenix is #1, 11.6% inflation in Phoenix. San Francisco is last, 5.5% inflation. So the inflation in Phoenix is 2 times as high as San Francisco. Now, I think we know kind of why that is, right? San Francisco's economy got hurt during the pandemic. People moved to Phoenix. But I think the question is, now that Phoenix is experiencing 11.6% inflation, I think we all know that's not good for the health of the economy, especially when the wages are only up 5%. And so I wonder if some of these high job growth markets are going to run out of steam, because it's almost like the things that are going on there are happening too fast and they're not sustainable.
Yeah, I think you actually gave the perfect response to that, because, that's something I didn't really think about. And it's definitely something you need to look at. Like, okay, just because they're having a lot of job growth, how many people can actually afford the home prices in these areas now? And one thing I even mentioned in that video was, okay, you have all these home prices going up. You have, rich people moving into the area, but how many people that were already living there and working regular blue collar jobs can still afford to stay there? Who's going to serve you at the restaurant? Who's going to be the clerk to check you out at the store? Because who can live there anymore?
It's a great point.
I think that's something that could easily contribute to a housing market crash in an area that can even seem economically good at the moment.
Yeah, that's a great point. I think the thing to think about is, does this seem stable, right? And maybe that's a hard thing to answer, a hard question to answer. Like, I don't know. I look at Dallas. I live in Dallas, right? And to me, what I see in the economic growth in Dallas seems more stable and sustainable to me than what I saw in Austin when I lived there. And that was just a flavor I got from living in both of those areas. But I bet you, if you would know more in Florida, clearly. But I don't know. Are there places in Florida where you say to yourself, all right, I see the economic growth, I see the migration, it makes sense, versus places in Florida where you're like, I don't know, there's something that doesn't feel right about this?
Yeah, absolutely. I think the #1 place that comes to mind for me is Orlando. I see that area has gone up so much in price over the past couple of years, and I don't think the job growth there is going to support that, because a lot of the jobs there are mostly the tourist industry jobs, people working at theme parks and all of the businesses that support that type of tourist industry there. And let's face it, if you're working at one of these places, you probably can't afford a 350 or 400K home that used to be $200,000 or $225,000 just a couple of years ago. And I think that's probably one of the first places in Florida that's going to run a steam. But I also think that probably parts of the west coast of Florida are going to be in trouble. Like, for example, anywhere between Naples, Florida, and let's say south of St. Pete, and that area could be in big trouble in the next couple of years, because there's still a lot of buildable land in that area. There's a lot of new construction happening, and prices there have gone up more than pretty much anywhere in
It's
Florida.
it's a good point. I'm going to share my screen again just to take a look at Florida so we can walk through some of these areas. So you were just talking, but just to zoom out, here's Florida. And so you were mentioning Orlando, which is what Orange and Osceola County are the two big ones. And yeah, inventory is down 40 to 50% in these areas. And like you said, prices are way high and their economies are just service based, right? And I actually think Orlando is pretty high on the list of remote work havens. So I think a lot of remote workers are moving in. But that's another thing I question. What's the sustainability of that demand source? Remote
Sure.
workers moving in, because they don't have an actual tie to the area. Then we move to, like, it's crazy. You mentioned St. Petersburg. I was there 2 months ago. I mean, it's off the chain right now, the stuff that's going on there. But I think you're right. Like Northport, Sarasota, I think some of these areas, Cape Coral, they're building so many homes in some of these counties. Like some of the biggest increases in home building in America, especially in Naples too. And clearly the people are moving there now, right? But I don't know, at some point, if there's any slowdown in that, I think you're right. These housing markets in Southwest Florida are pretty exposed.
Yeah, and I think anybody who's buying in one of those areas right now and overbidding for a home there, they're going to be suffering the next couple of years when all this new inventory comes to market. Because if you go to the right of your map there, like where I live in Miami-Dade or anywhere on the east coast of Florida, we don't have nearly as much building going on over here.
Sure.
And there's really nowhere left to build. We have the Atlantic Ocean on one side, and on the other side, we got the Everglades. And in between there, everything that's built is pretty much already built up.
Yeah, you're certainly right about Miami-Dade. Miami-Dade single family home permitting is similar to LA County in terms of how low it is. So I think you're right. There's legitimate supply constraint in Miami-Dade County. I think in Palm Beach County, they build a decent amount. And I think in Port St. Lucie, they build a decent amount. But I think you're right. Broward and Miami-Dade are much more supply constrained in terms of what people can build, at least from single family homes. They do build, correct me if I'm wrong, a decent amount of condos. But
yeah, they do build condos, and they do take down old condos in order to build new ones sometimes, or take down like an old, building that's been abandoned, and they'll build a new development there. But what a lot of people don't realize is all those new developments are only being built for millionaires. If you don't make multi-millions of dollars per year, you can't buy one of those condos. We're talking starting prices anywhere between 1 and 4 million for a lot of these properties.
That's crazy. Yeah, it's certainly not serving the first-time home buyer.
No, absolutely not.
Yeah, and I think we touched upon something there, home building. That's maybe an important thing to talk about because, there's like two conflicting narratives, I think, going on right now. Like on one hand, there's a narrative that there's this housing shortage, we haven't built enough homes, and we're not building enough homes, which certainly is understandable given what we're seeing in the housing market, why people would say that. But then on the other hand, when you look at the data, we're actually starting and completing more homes now than we have in 15 years since the last housing boom in the mid-2000s. So, and specifically in certain cities, again, where we're seeing this big building boom. Southwest Florida is one of them, where down from Northport to Sarasota to Cape Coral to Naples, just home building is going crazy. Same with Port St. Lucie and Palm Bay, as well as some other parts of like Central Florida, like Ocala. I don't know if that's Western or Central, but Ocala has a lot of building. So does Pensacola. If you go to Texas, I mean, Austin and Dallas and Houston are building more than they ever have. San Antonio's building more than it's ever have. Utah is building more than it's ever have. So is Idaho. So there's a lot of places in America where this, housing shortage, we're not building enough homes, I don't think is accurate because there is a huge surge in building. Now, in the short term, there's all these buyers putting down money for contracts and whatnot. But I did a video on this topic a couple weeks ago on my channel about how I think there's gonna be a lot of canceled contracts for new homes. Because there's this phenomenon right now where people put down a deposit for a new home, before it's built. And you'll put down a deposit like 2% of the purchase price, maybe 10 grand, and then they'll build the house and it's supposed to take 6 to 8 months, but now it's taking 9 to 12 due to the construction delays. Most people do not lock their mortgage rate when they put the deposit down. They lock it when the home is delivered. So you have all these people who put deposits down in mid 2021, late 2021, mortgage rates were 3%. By the time the home is delivered, their mortgage rate's 5% or 5.5%. And so I think you're going to see a lot of people walking away from these new home contracts that they put deposits on because they can't afford it. I'm not sure if that's something you're familiar with at all, or if you have any thoughts on that.
Yeah, I do
Phenomenon.
have some thoughts on that, actually. My first thought is, okay, new construction, a lot of people think that's going to be the savior, right? This is going to save the housing market. You know, we all need just more houses. That's the problem. But what a lot of people don't think about is a lot of those new houses are a lot more expensive than a house that's sitting on the market right now that's already built. I mean,
Yeah.
it probably can vary by your area, but let's face it, just like I was mentioning about these brand new condos, a lot of these new homes they build, maybe 400 or 500K is the starting price for many of them, and probably even more in some areas. So how many people can actually afford that, especially with the interest rates going up? So I think the one silver lining in that would be if people do walk away from these new homes that they're being built, like you mentioned, and it all comes to market all at the same time, well, then that's actually going to be the crash that we've all been waiting for. And hopefully the price of those homes will finally come down.
Yeah, I think that's a great point. The home builder profit margins have been through the roof. So the home builders have been complaining about materials costs and labor costs, but when you look at their financial statements that they report, because they're publicly traded companies, you see that they're actually making more money than ever, at least in 2021, which suggests that they are just jacking up the price of the homes rather than that being driven by their costs truly going up. So I think that'll be interesting to monitor. But again, that'll be in specific markets where there's lots of home building and lots of speculative home building, especially.
Yeah, absolutely. Do you track any data, Nick, with as it pertains to the price of these new homes? Like, do you know any areas that you have a map showing, like, okay, the price of homes here that are being built are, let's say, an average 300,000, whereas the new homes being built in this area are 500,000?
Yeah, I don't have that. So I know more broadly, like the US Census Bureau reports on the price of new homes in general. And you can see that broken down by region. So you can see how much are new homes being built for on the West Coast versus the South versus the Midwest versus the Northeast. So you can know it more of like a broad brushstroke, how much the new homes are costing and people are purchasing them for. But it's difficult to get that granular detail by county and market for new homes only.
Right.
But you could certainly see it for, more broadly, the entire market, how much appreciation there is. And I've looked at some data that actually shows like the increase in the new home price is pretty similar to the existing home price. It's pretty, they're both around 20%. So it hasn't been that different. But, what's interesting, speaking of existing homes, right? It's like, that's where the inventory shortage is, right? It's not on the new homes. We're building a lot of new homes. It's, I think, just a lot of existing homeowners have been kind of clutching their house, not wanting to list it, or, buying a second home and not listing their first home. I think that's really where the inventory shortage is and where it needs to be solved, more so than just new home building, like you said.
Yeah, I just wonder if a lot of these people who are holding on to the listings, if they're ever going to list, at least anytime in the near future, because even if the market starts correcting, well, there's another incentive for them not to list because they're not going to want to take less for the property unless they've been planning on moving for a while and they just haven't because rates are getting too expensive and the price of homes are getting too expensive. Maybe that would be an incentive for them to list just so they can actually make the move that they've been wanting to make. But other than that, if the market starts correcting, I can't imagine why anyone hanging on to a listing right now would list when prices are going down.
Sure. That's a good point. I think the thing to remember is it's kind of housing crashes are like slow motion a little bit. It's not as if the market will go from, the typical home value being 500,000 to it being 400,000 in 6 months. It'll happen incrementally. And I think we're already seeing this on the West Coast. You're seeing sellers wise up to the idea that we're at the peak. So I think that's what's going to bring a lot of sellers to the market, is the thought that we're entering the peak, we're at the peak. You're already seeing a lot of mainstream outlets and sources. I'm seeing a lot of realtors on Instagram post things about like, you better sell your house now, before it's too late. And so, the other thing to think about, you mentioned, a lot of people delayed their home listing during the pandemic. Over 1 million fewer listings occurred during the pandemic. And there's typically structural reasons why people list their home. They want to upsize or downsize or move closer to family or move away from family or move closer to work or move further from work if you're a remote worker. There's these things that are often very structural life decision things that cause people to list their home that are not really negotiable in many circumstances. So I think, we have over 1 million fewer people who've listed their home since the pandemic. I think a lot of them are itching to list their home. They're just waiting for inventory to go up to a level where they feel like they can find a new one when they list their original one.
Yeah, I see that being basically the perfect storm, in my opinion. As a real estate agent, all these listings coming online at the same time. We've all been wondering when that housing market crash is going to come. That very well could be it. Everybody decides to list. And my personal feeling, like my gut is already saying that it's too late. If you didn't sell already, maybe if you list right now, you're okay. But if you list, probably by the time summer comes, you could be too late.
You could be too late. Yeah, I mean, the market could change quickly, given how fast prices went up. I think another thing to think about that's interesting to me is if you zoom out and think on a worldwide global level, which, we're so focused on America and we were looking at the counties and inventories in America, which is of course very important. But if you just zoom out for a second and you understand this housing bubble is worldwide. It's in America, it's in Canada, it's in Australia, it's in the UK, it's in Sweden, it's in the Czech Republic, it's in all these places. And so you ask yourself, what does that actually suggest? The fact that this is a worldwide housing bubble. All of these countries have different demographics. They have different ages. They have different, economies and wealth factors, and they have all these different things. But all of them are in a housing boom, in a housing bubble. Why? Why is it worldwide? And then, the two things I'm thinking about, the two consistent trends among all these different countries are, number one, the pandemic, and then number two, low interest rates.
And so also human behavior is the same everywhere.
And human behavior is the same. But why is it the same? Well, the pandemic and low interest rates, that happened everywhere. Those two things. And to me, that suggests it's like, look, what we're seeing in the housing market right now is not some mystery, due to, people talking about millennials and underbuilding and this and that. No, this is happening everywhere because of the pandemic and low interest rates.
Absolutely.
And so, the pandemic increased the demand for space. It increased the demand for owning a home and also potentially increased the demand for buying a second home and an investor home. And all of that was aided by the low interest rate environment we were in. So it's natural to assume if the pandemic normalizes, which it seems to be normalizing, and interest rates go up, we're going to see a reversal, right? If these were the two consistent trends that explain why all these different countries are in a housing bubble. And so I think it's helpful to think about things on a worldwide, more zoomed out scale sometimes, even though everyone's kind of always concerned about their zip code and county, which does matter, but just think more broadly, what's driving this housing bubble? And it's those two things with a big assist also from government stimulus.
Yeah, for sure. Well, I think you give some excellent points, backing up your housing market crash prediction. I don't know anybody else on YouTube that can back up the opinion like you do. So I appreciate that you shared that with me here today on our channel. And what do you think about taking some questions from the audience?
Let's do it. Love some live Q&A. Let's get this going.
All right. I saw one up here that seemed like a good one. So put your questions in the chat, guys. We're going to take some questions here. This might be a good time to pull up that map of Florida here, Nick. This one asks, comparison feedback for St. Johns County versus Clay County. What's your views on buying now versus waiting to early 2023?
Sure. All right. So St. Johns County versus Clay County. So just in terms of timing, right, and where the inventory is trending, we're still down 28% homes for sale in St. Johns County, but we're now up 13% in Clay County. And look, inventory is still low in both areas, but we're starting to see the softening happen in Clay County first, which I suspect potentially, might have something to do with the slowing of migration out of Jacksonville and other parts of the country. Just from looking at this, I would say you'd have a better chance right now to buy in Clay County than St. Johns County. A big question to ask, though, is where would I rather be for the long term? because as we talked about right now, you do not want to buy a place today that you feel like you are compromising severely on, right? If you have to compromise in a big way and say you hate Clay County, you really want to be in St. Johns County, I would say it would be just better to wait it out. But if you do find a place here, the inventory is up, you could have a better chance of finding somewhere that suits your needs. I think the question also asked, waiting to early 2023. If it were me, I would wait to early 2023. That's if it were me. I don't have a gun to my head. I don't have a baby on the way. Like, I don't need to buy now. So I want to see how the increased construction and the higher interest in mortgage rates play out in the market before I pull the trigger.
Yeah, I think that is 100% solid advice. And that goes back to what we said earlier. If you're not desperate or you don't find something that you don't like, definitely waiting is probably a good thing to do right now. Let's see what else we got here. Okay, this is a good one. How much of the new housing is getting bought by investors for rentals? Do we have data tracking this?
Yeah, actually very few. So this is, the one positive of new home developments is that they primarily get sold to end users. According to the U.S. Census Bureau in 2021, 94% of all newly built homes were financed with a mortgage. Many of them were FHA, first-time home buyer mortgages. So the newly built homes are much more likely to be bought by an end user. That's because a lot of the builders actually won't sell to investors. They'll make sure that you're a primary home resident. So that's a silver lining, is that the new homes mainly get sold to end users. The investors are buying existing homes by and large, whether they be big private equity funds or big hedge funds. A lot of people talk about BlackRock. I think BlackRock is kind of like the symbol. I don't know necessarily how much they're buying themselves, but they buy existing homes. And I talked about this in my last video that just came out yesterday on how I think the Federal Reserve is planning to crash the housing market. But I think a lot of these investors are going to be in for a rude awakening in 2022 as interest rates rise. Because what a lot of people don't know is this: when the investor goes to make the offer on the existing home, yes, it's a cash offer, but the source of that money is not cash. It comes from a bank. The way that these investors operate is they raise big funds. Maybe 70 to 80% of the fund comes from a bank credit facility. And that credit facility is adjustable rate. It's floating most typically. So when we see the short-term interest rates go up in 2022, that's going to increase the cost of borrowing for these big Wall Street investors, which I think is going to create big problems for them in effectuating their strategy of buying up homes. So this is a trend to watch in 2022. Clearly, 2021 was the year of the big Wall Street investor buying up homes. I do not think it will be as easy for them to do that in a higher interest rate environment.
Yeah, and for everybody out there watching, whatever Nick just said, this is good news. If you are in the housing market right now looking to buy, then this information is going to be helpful to you, because that means you could have a better chance of actually getting your hands on a better property the later part of this year or even going into next year. So anybody that hasn't FOMO'd into the market yet, you're doing yourself a favor, and it's probably going to pay off.
Yeah.
So here's another one. Somebody else is asking about the Sarasota area. Can you pull that map up of Florida?
Yeah, I'm going to pull the map back up. Sarasota is pretty high on my bubble list, I'm going to be honest, because it meets a lot of these criteria that I talked about earlier of a market that would be in a bubble. Because, okay, look, inventory is still down 38%. So, look, Sarasota is not going to crash tomorrow due to that lower inventory. But when you think about the profile of Sarasota, they build a lot of homes, pretty much more homes than any other market in America. There isn't really a good economic base in Sarasota. Most of the demand is coming from lifestyle-oriented people or retirees. Has one of the oldest homeowner populations in America, which is nothing bad in and of itself, but that means that a lot of the housing units each year are going to be given up by people who move into nursing homes and unfortunately die. So the long-term perspective for me on Sarasota is not so good. Sarasota, Naples, Cape Coral, I think in the long run, these markets are going to struggle. I would probably wait for another year, before get some inventory going back up. But I think even if you wait a year in Sarasota, you should be pragmatic and realistic about the fact that this is probably not going to be a good appreciation market in the long run due to all the home building, the demographic headwinds, as well as the fact that the local economy there is just very lifestyle oriented and doesn't really have a big driver.
Yeah, absolutely. And while you got that map pulled up, another one came in here about, oh, that's not the one, about Tampa. Let's see. They're asking us, what do you think about the future of Tampa? Um, Inflation looked really bad in one of the charts that you put up on your channel. I think it was one of the community posts you
Yeah.
shared, probably showing where inflation was the worst.
Yep. Yeah. I mean, look, Tampa, inflation's bad in Tampa. It's over 10%. That's not good. And I think we're getting to a point in Tampa where people are going to start leaving. I'm already seeing that. There's a commenter on my YouTube channel who owns a rental company in Tampa. I see him commenting, and he says he's already seeing that. People are starting to leave the area and find places that are more affordable because the rent's up 25% year over year. So Tampa is a place I'm skeptical of. I don't necessarily think it's in the biggest bubble ever. I like it better than Sarasota and some of those markets like Naples, but I would be careful, especially we have a lot of home building in some of these northern counties like Pasco and Hernando. I think there's definitely some inventory risk here, given all the home building that's occurring. And then we have a lot of home flipping. There is a lot of home flipping in St. Petersburg. There's a lot of home flipping in Hillsborough County, and that's increases speculation. So look, I think especially Hillsborough County will probably perform the best. It's the youngest county. It has the least home building, but overall Metro is at risk, but I don't think it's going to happen overnight. Tampa inventory is still very low. So you have another probably 6 to 12 months before things start heading south.
Yeah, I just wonder where all these people who are going to leave Tampa, where are they going to go? Because obviously Tampa is probably one of the coolest places to live in Florida, and almost anywhere else they go, if they're going to stay in Florida, is going to be a downgrade for them. And it's not going to be any cheaper. Let's face it. If you come over here somewhere to Miami or, Northeast Florida, it's expensive everywhere now.
Yeah, that's a good point. And so this is actually goes back to migration trends and predicting where people are going to move in 2022 and 2023. There's actually like a very cyclical nature to migration in America. If you look at 30 years of data from the US Census Bureau on where people move, it actually kind of follows like a trend where every 10 years or so, we have this big movement and exodus to the South. And what you saw, I want to say in 08, 09, 2010, 2011. So think about like right after housing prices peaked, and started going down, you saw people moving to like the Midwest. You saw a place like Pittsburgh did really well during the last housing crash in terms of migration. You saw people moving to certain areas in the deep South that were affordable. And so I think you're right. Maybe someone in Tampa might be kind of like out of luck in Florida, but I think you're gonna start to see people leave Florida. This is a thing that a lot of people don't want to think about. They only want to think of like Florida's only going to have people moving there, but the dollars and cents equation says that Southern Georgia and Alabama and Louisiana and certain parts of the Midwest are probably going to start gaining due to their affordability.
Yeah, that's interesting. I think so too. So long as they don't start reinstating some of those pandemic restrictions, I think they'll be okay.
That's a great point. I mean, that's a potential thing. Like we all think it's, we're starting to think it's over, right? But Philadelphia just reinstituted their mask mandate based off 150 cases. So,
right,
who knows?
Here's an interesting one, Nick. Somebody's asking, we keep using the word crash, but what does that mean? Are we saying prices will suddenly go down 50%, or prices are just going to become stagnant?
Yeah, that's a great question. And 50% is unlikely. Like, okay, let me just back up. We saw 50% in the last housing crash, 07 to 2012. Miami, Tampa, there were 50% declines. Vegas went down by 65%. We saw like blood in the streets like we've never seen before in the last housing crash. I don't think we're going to see 50% this time, and probably in any market. But I think we're going to see some 40s, 30s, quite a few 20% declines. And I would say most places are probably going to be around a 10% decline when all is said and done. Now, that's going to bring values back to maybe where they were a year ago in a lot of places, maybe 2 to 3 years ago in the places that get hit hard the most. The thing to think about, though, why even a 10% decline in home values is very meaningful, and I think is deserving of the word crash, is you got to think of how these homes are financed. The average down payment in America is about 10%, maybe even slightly less. So if home prices decline by 10% or 15%, that's a big problem because all of a sudden lots of people are underwater now on their mortgage. And that's because the leverage ratios are so high, especially with FHA loans. It's like a 95% leverage loan. So if you have a 15% decline in a market with a lot of FHA loans, that's a big problem Lenders are going to be less likely to lend, and it's going to cause like a snowball effect. So that's why I think the word crash is relevant, even if it's a 15% decline, because for the housing market, that is a big decline, even if we don't see 50% like we did in the last crash.
Yeah, that's an interesting point, because my first reaction would be, okay, if it goes down by 10%, it's not a crash, it's more of a correction. Even by 20%, I would say that. But with the case that you just mentioned, it could easily be a crash because, hey, listen, if you need to list and your home is worth less today than it was yesterday and you don't have any equity, well, now you're in a short sale situation, or if you can't pay, you're going into foreclosure.
Yeah. I would say your 10%, you could say, is a correction. If we get to 20, that's a crash. Because when you look, say even before the 07 to 2012 crash, say you go to early 90s, LA went down by 25% in the early 90s. And that was bad. It was a bad housing crash when LA went down by 25% from 1991 to 1996. And that was a blood in the streets thing, even though, it was only a 25% decline. A lot of people got wiped out. So yeah, if you hit 20% or higher, that's pretty bad. If you stay in the 10% range, yeah, I guess we could call that a correction, but certain people are going to be underwater.
Yeah. Well, this one I really like, and I'll go first on this one. How high can interest rates go? Is there a level or a cap? There is definitely no cap. It can go as high as it needs to go. If we look back to the 1980s, interest rates were up to close to 18% for a 30-year fixed rate mortgage. But the difference was back then, prices were much lower than today. I don't know if they're going to go up to 18%, but they've been rising very quickly here in 2022, much faster than the predictions have initially, showed us. So I think by the end of the year, we could easily be looking at 7 or 8% if it keeps going in this direction. What do you think?
Yeah, I'm a little torn and conflicted on this, because on one hand, the point you made about home prices being higher in the 70s and 80s is a very important one to pay attention to. I don't think, people reference the double-digit mortgage rates from the 80s and say, well, they could go up higher, but the prices were so different, right? And that's really important. It's not just the mortgage rate, it's what the prices are and the appreciation is. And I don't see the room in today's housing market for rates to hit double digits, because the market would collapse on itself if that happened, given how expensive the home prices are. Now, I do think there is room to go above 5%, especially when you consider the power that the Federal Reserve has over mortgage rates. We all know what they can do with short-term interest rates and increase that. But what a lot of people don't know is that the Fed owns $2.7 trillion of mortgages and mortgage-backed securities. They started buying them about 10 to 12 years ago after the last crash, and they really started buying them when the pandemic hit. So the Fed right now owns over 20% of the US mortgage market, and they are going to be rolling those mortgages off their balance sheet starting in May. And there is a possibility that they could start outright selling those mortgages into the mortgage-backed security market. And if they do that, that could really destabilize the mortgage market and cause mortgage rates to go up. I don't know. I don't think the Fed wants to totally destabilize the market, but they've made it very clear that they want to wind down their mortgage-backed security portfolio going forward in 2022. So that likely means mortgage rates are going to go up further. If I had to put a cap on it, I don't know. I feel like the market folds in on itself if we hit 6. And if we go above 6, I don't think there's much room above that for the market to not go down, if that makes any sense. If we were to go to 7, I think it's lights out. And prices go down. And then you enter a phase where mortgage rates would go down because demand goes down.
Yeah, which I think probably everybody watching this right now, for the most part, wants to happen. Listen, most people are desperate for a housing market crash. I think this is why this is such a hot topic right now, because so many people just want this to happen, because people are hurting. People who would normally be in the market to buy a home right now are just not able to do it. These bidding wars are getting old. I would never advise one of my clients to waive an inspection or an appraisal. And if you're in one of those situations, I feel for you.
It's tough. It's a tough situation. I think we talked about this before, Michael, but I don't even think existing homeowners like this housing market that much. Obviously people like some of the appreciation they've been getting, but it's almost like you can't even do anything with it if you wanted to go buy another house.
You're trapped.
You're trapped. You're trapped by your appreciation.
Imagine that.
Interesting situation.
All right, let's take one or two more here.
All right.
Let's see. How will interest rates affect
Hmm.
foreign investors of property?
That's a great question. So higher interest rates means a stronger US dollar. And Michael, you probably have some perspective on this being in Miami and seeing I guess I could think of it in two ways. When the dollar appreciates, wouldn't that make it harder for foreign investors or just make it more expensive for foreign investors to buy, right?
Right. However, at least here in Miami, most of the foreign investors come in here with cash. So I don't see that hurting them as much. But obviously, if you are looking to get a loan, then it's going to be much more expensive for you converting your foreign currency into dollars and at a higher rate on top of that.
Yeah, but wouldn't that also apply for the people buying in like say people with Venezuela or Brazil probably buy in Miami? If the dollar appreciates by 20%, that's almost like the house just got 20% more expensive for them, right?
Oh yeah, absolutely. So I mean, cash, you're still looking at that exchange rate being more expensive, but if you're looking at using financing to buy a home as well, on top of that
That's a
exchange rate,
double
you're
whammy.
getting
That's
crushed.
a double
Yes,
whammy. Yeah.
exactly.
So I guess we would think that stronger dollar probably discourages somewhat foreign buyers from buying, but there's probably other things that impact that as well beyond just the interest rates.
Yeah, except for the one caveat being that I think if you look at a lot of other expensive markets across the world, different places like Miami or New York or LA, some of our hot markets here in the US can still be somewhat affordable compared to, places like Hong Kong or,
Sure.
somewhere
Paris.
in the Philippines or
Yeah,
whatever.
that's true.
Yeah.
That's a good point.
All right, let's see what else we got here. This is a good one. What keeps pushing rents up in South Florida? Well, I think it's the same thing that's pushing rents up everywhere. It's a combination of two things. One of it is just greed, guys. People are greedy right now. Even like Nick said earlier, home builders are showing record profits because they're just raising their prices because they can right now. A lot of landlords are doing the same. That's the first thing. And the other thing is back to the inventory. People still aren't moving as much. And if you have a good deal in rent right now, why on earth would you give that up to go somewhere else unless you absolutely had to?
Yeah, I think you nailed it, Michael. I think you nailed both of those things. There's certainly an element of speculation and greed, and there's certainly an element of the inventory is low in the rental market, just like it is in the housing market. I'm also curious to see, we're seeing a slow unwinding of the eviction moratorium. I'm curious to see how much that softens the rental market in certain cities. Even though eviction moratorium has been gone now for 3 to 6 months, the evictions are still slowly trickling in certain places. So I wonder if that has something to do with it. Another thing I'm curious about, and I feel like this is happening anywhere, it'd be in South Florida. Investors are buying properties, right, that they want to rent out. But then often they will renovate these properties before they rent them out, right? How many homes are being purchased by investors right now that are just actually being sidelined off the market because they're either being renovated or there's some type of lag time between the investor buying it and then getting it on the market as a rental?
Yeah, absolutely. And that just brings up another point you made me think of, that if someone were to do that, like an investor, for example, and they want to get the most out of that property, not only are they renovating it, but when they put on the market, it's not going to be hitting the regular normal rental market. Chances are they're going to be putting it on Airbnb, trying to make the most money they can out of that property, out of short-term rentals, because that's something that seems like has not slowed down at all during the pandemic. In fact, probably just got even better. And, if you're buying as an investor and you want to make the most out of your property, renovate, and you put on Airbnb and you're making triple what you would as, renting it out on an annual basis.
Yeah, what's interesting? I from my monthly newsletter that I offer my channel members, I did an analysis on the markets that had the biggest increase and decrease in Airbnb inventory. And it's kind of spotty. So like Tampa had a big increase in the amount of Airbnbs in the Tampa metro, but Miami actually had a decline, interestingly, from the pre-pandemic levels. Maybe they're back to the norm, but it was interesting. It was like New York and Boston and Miami and LA and San Fran all had a decline in Airbnb inventory, but then Charleston and Tampa and Dallas and basically all the places people moved to during the pandemic had an increase in Airbnb inventory. So that's an interesting one that I think is market by market. But to give perspective, in Tampa, the amount of Airbnbs on the market, I think I calculated, accounted for about 2% of all housing units. And that was the highest I saw. So in the worst market, the short-term rentals would be 2% of all the housing units. And I think in the average market, it's like 0.5%, which is meaningful. I mean, that is meaningful. But it's not like, 10% of all the homes are on Airbnb.
Yeah, that's actually encouraging news. I didn't even know that. And if it's only 2% in the worst case scenario, then that still gives people hope that maybe we'll see some of those rentals coming to market.
It's happening at the margins, I would say. It is impacting the market, the short-term rentals, by pushing long-term rental prices up, but it's not, I would say it's probably 10% of the explanation.
Oh, that's good for
Yeah.
sure. So what do you think? You want to take more, or should we call it a day?
Let's take another question. Yeah, let's go.
All right, let's take another one. Well, why don't you pull that map back up? Somebody's
right.
asking about a different area of the country. They're asking about, how about my home area of Cleveland, Akron, Ohio? My townhouse is at record value after being in negative value from 2010 to 2015. Would it be like Pittsburgh and remain stable from the last crash?
Yeah, that is a great question. I love when people talk about the Midwest because it is underrepresented. Let's look at where we're going on in Akron. So yeah, we are seeing some softening more broadly. Just, one thing I like to do is just looking at Ohio. We're seeing certain clusters of blue in the center of Ohio. So we're starting to see, okay, Ohio is softening. Now, in terms of Akron, inventory is still low in Summit County. It's only 1.6% up year over year. So it's still down from where it was 2 years ago. But we are starting to see some translucent blue also in Cleveland. I think, look, Midwest Ohio, this is going to be an area that softens pretty quickly in 2022. I don't think we're going to have a crash, so to speak, in Akron. Like Pittsburgh, Akron tends to be more stable. Home values don't tend to go down by too much. I wouldn't be surprised if there is a correction on the order of 5 to 10%. But in terms of the question, as what to do with your townhome, I think it really depends. Like, if you have a compelling reason to sell, and there's like another place you want to move to or another home, it's like, yeah, I guess now would be a good time to do it. But Akron doesn't strike me as a type of market that you need to worry about the value of your property going down by 30%. So I think it's kind of a personal decision there.
Yeah, and I agree. Being from the Midwest, like where I grew up, you don't see these big swings in the housing market crash. Like when I moved to Miami in 2008, the prices were literally crashing as I was moving here. And they did have a little bit of a downturn there, but it was a very small amount. The downside is, though, it takes those areas much longer to recover from any type of downturn, just because there's not as much, supporting that economy.
Sure. Actually, while we're here, I want to just pull up New York. I don't know if anyone watching this is in New York, but I think New York is an interesting market here, just to talk about inventory and softening. So, and like the differences that can exist in different areas. So like if we look at Manhattan, inventory is up 34% year over year. It's up in the Bronx. This is one of the few areas where inventory is higher than it was 2 years ago. But if you go to like Nassau County and Long Island, if you go to Westchester, inventory is down 30%. And so, this is definitely something to pay attention to. Like, we talk about the county level, at the metro level, but, really there could be differences going on in your backyard that, clearly you're going to say New York and Manhattan and the Bronx are closer to a crash here than Nassau County. And so that's why this inventory data is so important for you all to look at. We're looking by county here. For my channel members, I look by zip code. Just did a live stream for them. And this data comes from Realtor.com. So definitely check it out if you get the chance.
Yeah, definitely go check that out. Nick's channel is called Reventure Consulting. So anybody interested in seeing more of this data, you can always find it over there on his channel.
Yeah, that's right. 3 videos a week. Got another video coming out tomorrow about some of Redfin's predictions on the housing market. I'm not sure if you saw their article, Michael, from last week, but they talked about some housing markets that they saw that were already slowing, some early indicators of that. So interesting when a company like Redfin actually calls that out.
Yeah, it is interesting because obviously they're in the business of selling homes. So
yeah,
That's the last thing they want is prices going down and sales to slow.
Sure, definitely.
Well, Nick, it was a pleasure having you on the stream. Thanks again for joining me and backing up all of your housing market crash claims. It's much appreciated.
Yeah, thank you, Michael. This was fun. Let's do it again soon.
Yep, absolutely. Thank you, everybody, for watching, and we'll see you next time.